There's very likely a massive stock market crash coming. And today we look at why this need not matter to you. So hello and welcome back to our channel. Over the last 2 years or so, I've shared nearly 50 videos aimed at helping people very significantly improve their finances. And as I've said many times before, learning enough to make a genuinely life-changing difference to your financial future is nowhere near as hard as many people think. It's just that so few people ever do it. Over the course of our video series, I've done my best to break down all the key concepts you'll want to understand to make a really big and tangible difference to your life in bite-sized chunks of about 12 to 20 minutes at a time. And as I showed in my last 2 videos, this information can increase the chance that you might get a 6 or even 7-figure result for your net worth if you take the time to get investment roughly right. As of now, our video course gives you the lion's share of what you need to help you look to get that result. All you need to do is watch all of the videos in order from oldest to newest. Or if you want a slightly faster route from A to B, I've also provided a number of playlists so you can home in on some of the most important videos topic by topic. But there really is no substitution for watching the whole video series in order. Or, as I said in my last video, if you are willing to make a small investment, you might also consider getting hold of my 2 personal finance books. How to Own the World is the big picture theory and explains all about financial markets and the history of financial markets and how they work. And Live on Less, Invest the Rest is more the practice of how you might get everything humming. In many ways, as I've said before, it's like the companion workbook to this video series. I appreciate that our video series is now some way north of 12 hours of content, which is probably also roughly the same time it will take the average person to read my 2 books. And this is a significant investment of your time. But as I said in a video I published last year, money is a long-form thing. The result you're looking for here is nothing less than life-changing. So I'd argue, as I have in the past, that it is well worth taking the time to get to grips with these topics properly. And as I've also said before, whilst you do need to commit a few hours, learning enough here is certainly no harder than learning how to drive. If you think back to when you learned how to drive a car, how long did that take you? I would argue probably the low tens of hours perhaps, including the time required to pass that multiple choice theory test. Most people, or indeed a lot of people, think it's fairly normal to learn how to drive a car and pass your driving test, and this doesn't seem particularly unusual or enormously difficult. But when it comes to financial markets and investment, most people don't even try. And they certainly don't commit as many hours as they do to learning so many other life skills like learning how to drive. Personally, I think this is a crazy societal blind spot and one which we really do need to overturn for all of our benefit. If you spend about the same amount of time learning how to drive your finances and your pension and ISA accounts in the main as you spent learning how to drive a car, that really should be more than enough. Enough to get started, at least. You probably weren't the best driver in your late teens, and you've probably improved since then, but you knew enough to go out on the roads reasonably safely. And the same is true of getting started with finance and investment. You just need to learn enough to get going in a reasonably sensible way. And then you've got many years to get gradually better, but the key thing is to get started. And I hope that the resources I've provided in this video series and in my books will help you do just that. So having got all of this stuff up in lights for you over the course of the last 2 years in terms of these videos and 10 years in terms of my books, today I wanted to spend a bit of time talking about what's next for this channel. Our company mission, big picture, is to improve the financial affairs of as many people as possible. And this is our North Star in all that we do. In the weeks, months, and hopefully years ahead, I'm going to continue to provide you with content that seeks to deliver that outcome for you. And with that end in mind, one of the most important things that I think we all need to be aware of at the moment, which is getting a fair bit of press coverage, is that it is getting increasingly likely that there's going to be a big stock market crash at some point. There's a great deal in the mainstream press and all over social media suggesting that the stock market is probably in a bubble and that the current AI and tech boom makes the investing world look a great deal like it did before the dot-com crash, for example. You might have heard that Warren Buffett, arguably the world's most famous investor, is currently hoarding huge amounts of cash, nearly $350 billion worth of it as it happens, and that the ratio or indicator named after him, the Buffett indicator, which compares the value of the stock market to the value of the US economy, is now even higher than it was ahead of the dot-com crash. Mr. Buffett did much the same in 1999 and 2008 in the run-up to those last two huge stock market crashes, i.e. he hoarded lots of cash, which is why so many people are talking about this at the moment. There are also lots of clever charts flying around showing that the current run in shares looks eerily similar to what things looked like ahead of those last two big crashes. Something called the Shiller-Cape ratio, or cyclically adjusted price-to-earnings ratio, is now above 40. And this has been incredibly rare in history and suggests shares are very overvalued. There are signs everywhere that we're probably close to some kind of horrendous stock market crash. As I said in a recent podcast interview, the list of property markets in the world at or near all-time highs is crazy, as are levels of government debt all over the world and the level of a large number of stock markets all over the world, not just the US stock market, and of course the prices of gold, silver, and Bitcoin too. You've seen mad end-of-cycle things happening all over the place, such as a lady in San Francisco who's currently being paid $30,000 by wealthy couples, very wealthy couples, to help them choose their baby's name, and Bitcoin treasury companies skyrocketing, even including one whose core business is actually African and Macedonian football clubs, of all things. But there are lots of pretty important things to say about all of this. First, arguably the single biggest theme driving the stock market in recent years, and particularly the US stock market, has been the inexorable rise of something called passive investing, the rise of ETFs. A huge amount of the money flowing into stock markets has come from ETF investors, and from ETF investors all over the world. And this has driven untold billions, in fact many hundreds of billions, of investment capital into the very largest companies in the world, largely or actually entirely without consideration of whether those companies are expensive or cheap at a fundamental level. I've been making these points for several years, and I'll explain more about the difference between passive and active investing in a future video, as I think it's likely to be a very important topic in the next few years. All of this has then been properly turbocharged by every asset allocator, so people running large pots of money outside of the US, basically being forced to be at least equal weight US equities, because when US equities are going up, it's very, very hard for somebody stewarding large pots of money in London or Singapore or Zurich or wherever else to not be invested in American shares. And this has driven the US market up even further. And another factor related to all of this is growth in something called algorithmic trading. And this is where computers basically automatically execute trades based on very cunning and complicated pre-programmed algorithmic instructions. And there's now a huge amount of capital in financial markets all over the world invested this way. Momentum is one of the key strategies that these systems use, which means that when shares are generally rising, many of these sorts of algorithms at the big hedge funds will generate yet more buy signals, driving markets up even further. Taken together, passive and algorithmic trading account for the significant majority of investment and trades on the US stock market nowadays. So all of this has been really important. These have been really important themes underpinning the increase in the level of American shares over the last several decades. And crucially, these themes haven't been anywhere near as powerful or haven't actually even existed in the past in many cases. So any indicator like that Buffett indicator I mentioned earlier that compares now to then might actually be a great deal less effective than it might have been historically. And this, to a certain extent, means that all bets could be off in terms of just how far this theme may have to run. There could be even more upside before the top finally blows. And there was a very good article about all of this in the Financial Times recently, for what it's worth, if you're interested in learning about this stuff in more detail. It was called "The Whole Bull Run is Because of an Influx of Money." This all having been said, if all of these things, or even some of these things, go into reverse, as they almost certainly will at some point, the crash this time could be as turbocharged as the rise has been, and really properly awful as a result. I'm talking about once in a century kind of awful. Most important of all, however, and the main purpose of today's video, is that I wanted to say again that within reason, you can make it so that none of this stuff need matter to you. It need not matter to your long-run ability to build wealth. None of these considerations need impact how you invest big picture. It is really important to be wary of the possibility of a massive financial crash. But in the main, so you can ensure that you're confident in your long-run investment plan and continue to do the right thing all the way through any given crash and beyond. I've explained all about this in my video series entitled How to Invest So That Crashes Don't Matter. The key is to continue to invest every month without fail in the right mix of assets based roughly on your age and stage, and do this for many years. As I've explained so many times in the past, most investors make many percentage points lower than market rates of return, which has a huge negative impact on their ability to become wealthy. And a huge part of the reason for this is because they attempt to time the market. And most particularly because all too often they give up and sell out in a market panic or crash, and very often don't go back to investment at all. This, the evidence shows us over about 2 centuries, is very likely to be the wrong thing to do. The right thing to do is to ensure you have a plan, understand big picture what you're doing, invest every month for many years in roughly the right mix of assets, no matter what is going on, and ignore the news, including any news about crashes. If you do this, you'll very likely do far better than most investors do. So given this very real chance of a stock market crash at some point, please do make sure that you've watched that How to Invest So That Crashes Don't Matter series and really taken the information to heart, to make sure that you can navigate it when it comes better than the vast majority of people will, including plenty of market professionals, no doubt. I would repeat a quote I've shared in my books from the excellent John Stepek, Bloomberg journalist and former editor of MoneyWeek Magazine. As he put it rather brilliantly in one of his articles a few years ago, there are many roads to ruin in the markets, some of them longer than others, but one surefire way is to set out as a buy and hold investor, and I would add a regular investor, and then attempt to turn into a market timer during a bout of market panic. This will do more damage to your portfolio than following one approach or the other. So that's it for today. I just wanted to make sure I'd covered this very important topic, at least before any crash does actually happen. It's really important for people to understand this stuff and ensure that you're psychologically strong and confident with your game plan as and when any big crashes happen. So in my next few videos, we're going to look again at how human progress is the most important investment theme in human history. Related to that, reasonably soon, I'll also be sharing some work on smaller companies and on biotech, and also on passive versus active investing, as I mentioned earlier in this video. And when I get a chance, I'm also going to be doing a series of videos on some of the big economic issues of the day in the UK and beyond, given how many of you have asked me to do this, given how important I believe this stuff to be for all of us and for your financial future, and given just how much utterly terrible information is out there at the moment and seemingly winning the popular argument too. And I think this is tragic for tens of millions of people right now. As ever, if you want to ensure that you're one of the first to see our videos when they're published, please do click the subscribe and bell buttons. And please, as always, please add any comments and or shout with any questions or suggestions for future topics. Please also consider subscribing to our free email service from the Plain English Finance website. And if you'd like to hear from me more regularly than just these videos twice a month or so, please do connect with me on any or all of LinkedIn, Facebook, and X. Until next time, and here's hoping that there's no crash between now and next time, I wish you and yours the very best.